Welcome back to IFX Academy, guys. Today we will be doing an annual recap and annual next year forecast projection analysis. So first we will be recapping what happened last year and what defined the movements in the last year to 2025, and after that we will be discussing what can we expect from 2026. And we need to understand, guys, in day trading, fundamental analysis does not matter a lot, and in swing trading it matters a little bit, but in position trading, in long-term moves, guys, they are mostly defined by the the fundamentals. Okay, guys, in day trading, we just need to avoid the news, avoid the data release points, avoid news news events, and we can just stick to technicals and keep on making money. In swing trading, yes, we have to like hedge for those news events, move uh, stop losses to adapt to news event volatilities, but still, guys, it isn't that much affected by news events. But guys, position trading or long-term trading, guys, investing, what we call, it is clearly affected by the fundamentals. Its main driver is fundamental itself. So guys, the defining theme of 2025 was that uh, it ended the post 2008 era of global monetary coordination, replaced by fragmented fiscal dominance. And what was the driver for that, guys? We had the Liberation Day, April 2nd, 2025, in which Trump imposed, the US unilaterally imposed 10 to 49% tariffs, fracturing the global economic order and sparking trade war 2.0. And he did increase those tariffs later on the other countries. And guys, we had the commodities market splitting up. We had the central banks diverging. The gold started rising, as most of you guys, oil traders, could should most probably know that gold and oil used to rise together and fall together. It was Oil was called the black gold. But now, guys, what happens? Gold is rising and the oil and the black gold is falling, oil is falling. That is a divergence. Why do we have that? Because gold is a safe haven currency. People, due to the geopolitical tensions, due to the trade war tensions, we had a lot of the Asian banks hedging themselves by buying gold. And due to a falling demand and global economic activity, we had a fall in oil prices. So, anyways, guys, the central bank mandates changed, and the correlation was 0%. The Fed was cutting, the BOG was hiking, the ECB was just watching what's going to happen. So, what we expect for 2026 is a landscape defined by protectionism and credit risk. So, guys, we know every country is at the peak level of their credit in history. For example, take the US, it's in the biggest amount of debt it has ever been in. And we have, so what we will see is countries trying to protect their own currencies, their own countries, by hedging against the dollar fluctuations, especially by investing in gold. So we've had that protectionism, sovereign risk, and end of the carry trade, because the main currency in carry trade was the yen itself. And as you can, as you guys know, the BOG started hiking in 2025, which led to the end of carry trade. So, guys, the Trade War 2.0 growth, the defining event of 2025, it reshaped global capital flows and equity valuations overnight. So, how did it happen? US invoked IEEPA to benchmark tariffs against bilateral trade deficits. Unilateral action bypassed, and they bypassed WTO, which is the World Trade Organization. They didn't give a shit about them, so they broke all the rules because they said we are the US, we can do anything we want, and hence the global tensions. The market impact, the initial impact was the stock market falling, but it later on regained itself. And the retaliation, China, China retaliated to US by imposing up to 125% duties on specific things, creating a primary drag on global growth. They kept on fighting. China raised the price tariffs. The US again raised the tariffs. At the end, they ended up reaching an agreement trade agreement ending the global dark, which started by the end of last quarter of 2025. So, and we had a great decoupling in the GDP of every of countries. The US led on with the GDP growth. It was fueled by government spending despite sticky inflation. The GDP, the the US kept on going, while the eurozone it faced a drag. It faced stagflation like the past 2 years, weighed down by German factory weakness and also the French retail weakness. Whereas the Asian countries, Asian stocks, they kept on rising. They had a good year, not that good, but they were uh, during the start of the trade war. The Asian assets all were falling, but once the agreements were reached, once the trade, the tariffs came down, they started rising again. So we have the great central bank divergence, and we will do a recap on what the central banks did. The Federal Reserve this year it kept on cutting, guys. It cut by minus 75 points last year on in 2025. Forced to pivot. Why did it pivot? It didn't want to cut at the end of 2024, but it had to pivot due to stagflationary tariffs and the Q4 government shutdown. And whereas we had the ECB, it cut a lot last year, but this year, guys, it kept itself on hold, trapped by sticky wage growth and fiscal dominance fears in France. The economies were weak. Germany was weak. France was weak. Spain was good. Okay. Italy was good. So, guys, we had kind of so they were unable to cut and unable to hike. So, at the start of the year, the euro was very strong, but by the end of was very weak. Sorry, the euro was very weak due to the Federal Reserve being hawkish and the ECB cutting throughout 2024. But in 2025, guys, we got a change. What we got was the ECB holding and the Federal Reserve cutting, hence going breaking the previous highs of last 4 years and 3 years. And then we have the Bank of Japan, the BOJ, guys. Finally, after 2 decades of minus interest rate, guys, it started to hike its policy rate from minus 0.1% to 0.7%. This is the one that killed the carry trade. Unanimous voting signaled the definitive end of the global carry trade. And then we have the Bank of England. The Bank of England, guys, it did cut. Hence, the Federal Reserve was also cutting. The Bank of England was also cutting. So we had a unilateral cutting. That's why we did not see uh, weakness in the pound against the dollar, but some strength. But it was not as strong as the ECB itself, as the euro. So, guys, now we will start with our first asset, which is gold. Guys, gold this year performed greatly. It was the defining asset of 2025. Gold severed its correlation with real yields, establishing itself as the primary neutral reserve asset in a fractured world. We had every central bank running towards gold, increasing their reserves, and we need to understand another point, guys. Post COVID 19, uh, all of the central banks, instead of just trading on contracts or holding the gold contracts, all the central banks, especially the Asian countries, have started demanding the physical delivery of gold, leading to unprecedented demand of gold seen in the modern history of the world. Hence, we have this unstoppable rise in gold. It is clearly and undoubtedly led by the fundamental factors. As you get, if you want to open any technical indicators, you would find the MACD overbought, the RSI in overbought condition, the stochastic, and etc. We will all get all of that. But we need to understand, guys, when fundamentals they make up a mind, you just can't fight them. You just have to go with the flow. Hence, we have the trend following nature in trading, we like to follow the trend. Why? Because guys, we are unable to define the trend. We are not trend makers, we are not market movers, we are trend followers, and trend are defined by the overall higher time frame trends are defined by fundamentals. Hence, leading to moves that cannot be explained by technicals. So we hence never counter trend trade. We stick to trend trading, trend following. So guys, the main factor was the revolutionary pivot. Trump caused panic in an already fractured world due to the Ukraine war, due to the Gaza war. We had it meant that the world was already decoupling from each other, and hence we had Trump put the final nail in the coffin, and we had a massive rally in gold, and and the Christmas gift from President Trump to gold buyers was the US naval blockade on Venezuela triggered panic buying in thin holiday liquidity. So, guys, we expect the gold to hit $5,000 by next year, and we expect to stay bullish. We may get correction, but we have to be careful. So, guys, let me know down in the comments what you think will happen next year and what can we expect for next year. So, guys, now we'll discuss the euro. As you guys can see, the gold kept on rising, guys, throughout the last year. Now we'll discuss euro. So, guys, initially in the euro, what we had was weakness, then strength. Weakness, as I mentioned in the starting of the analysis, we had weakness to the central bank divergence. The eurozone was the ECB was cutting, the Federal Reserve was holding after a massive hike, and we already had that difference in interest rates. So later on, when the ECB started holding and the Fed started cutting, we had a rise again. So euro US dollar on and off but resilient. While Q1 was plagued by German industrial fears, the euro staged a decisive recovery in Q4, driven purely by central bank policy divergence, as discussed. Post-tariff slump collapsed on fears of German factory order weakness following US tariffs, creating a drag in the eurozone outlook. The policy spread. The first half, we had a weak euro. The second half, we priced higher as ECB held rates, sticky wages, while Fed cut aggressively in September, October, and December, hence leading to a bullish euro. Guys, we expect the euro to stay bullish next year. And guys, this year's low was 1.0350. And next year, guys, we expect it to stay bullish. Again, I think it will start falling in the first half, falling down in the first half, and rising again in the second half. So, guys, now we come down to the pound. The pound, guys, was bullish as well. The surprise performance of 2025. While growth stagnated, the UK's unique inflation dynamics forced the BOE to maintain a significant yield advantage over the US and Eurozone. Sticky inflation. UK services inflation remained stubbornly high, preventing aggressive BOE cuts, preserving the yield cushion versus the Fed. Fiscal stability. UK government signaled discipline compared to US deficits and EU instability, attracting defensive bond flows. Basically, what happened is the euro is not performing that well. The economy is weak, uh, and the US is cutting. So a lot of money went into the British pound, keeping it bullish as well. But it was not as bullish as the euro. So what we expect next year, guys, for it to stay bullish, and our targets would be it to stay in the zone to 1.35 to 1.38 zone area. And this year's high was, guys, 1.3480. And most of the institutional traders are long on this, so we are also long. And guys, we come back to the dollar yen. Dollar yen fell from the peak after reaching breaking every record in history. Every record in book, dollar yen went to 160, guys. It touched, literally touched 160 and came back down and fell by a lot. Okay, guys. And due to we have a rising divergence in the central bank fiscal policy, guys, which will lead us to the Fed cutting prices and the BOG hiking prices. So after unwinding a lot of carry trades, I expect and we expect this asset to keep on going down to 125. After touching 160, we expect currently the price is at 160, but we expect by next year and the price will be touching 130 to 120. The BOG shock, BOG voted unanimously to hike rates to 0.75, signaling absolute resolve to normalize policy. Number two, yield compression. US 10-year yields fell on Fed cuts while JGB yields rose, triggering massive repatriation by Japanese insurers. The defining carry trade unwind of the decade as Fed cut rates. The BOG's historic period shattered the yield differential that had supported the dollar for years. So 2026 outlook, guys, don't fight gravity. Policy divergence, BOG hike versus Fed cut drives the payroll. Yeah, so guys, USDCHF, the ultimate safe haven of 2025, the franc broke decisively below 0.80 as capital Fed US fiscal dysfunction for Swiss political neutrality. The Swiss guys, these guys have been neutral throughout history, even during the wars, world wars, they were like neutral in between. So they have a habit of doing that, and because of this habit, guys, they were like the bank of the world unless and until US rose after the Second World War, leading to the rise of the Federal Reserve of the United States. And a lot of gold moved from Europe to the coffers of the Federal Reserve of the United States. The ultimate safe haven of 2025, the October panic, sharpest drop occurred during the US government shutdown. Investors abandoned US assets en masse and they moved to gold. And as we know, the USD CHF, the Swiss franc itself was once pegged to the gold and was considered as a gold currency, meaning an alternate for gold, buying gold. Instead of gold, you could buy the Swiss francs. So that it's not the same as before, but it still has that effect. So hence, it led a lot of investors going there. The failed intervention, SNB attempted verbal and market intervention to weaken the franc, but was underwhelmed by safe haven volume. So guys, these central banks, they have to maintain a balance, and they tried to maintain that balance, but they were unable to do so. So guys, USD CHF, what is our expectation? CHF premium persists amid US fiscal dysfunction and trade wars. So we expect the CHF to strengthen and the USD CHF pair to keep on following. And our target area, guys, is 0.7500, and this year's low was, guys, 0.7780. And guys, AUD USD, this pair fell a lot due to the trade war, then rose again due to the trade agreements. AUD USD, a tale of two halves after being crushed in H1. So first half by trade war fears, the Aussie staged a dramatic recovery in Q4, saved by a crucial geopolitical pivot. The APEC pivot, US and China signed a truce agreement, 12-month tariff pause, instantly removing the worst case scenario overhang. Soybean commitment, the soybean commitment, China committed buying 12 million tons of soybeans while US focused. It signaled open trade lanes for commodities, which led to an expectation that the US is also getting some benefit. So they expect the trade deals to continue, hence the rally in AUD USD. So the outlook for 2026, guys, the APEC Truce provides a 12-month runway. Currency remains historically undervalued, and we expect it to remain bullish. It's at an all-time lows, so we expect it to go higher. So this year's low was, guys, 0.6350. Terms of trade recovering momentum bullish. Guys, in USD CAD, the laggard, the the Canadian dollar failed to participate in the broader anti-USD rally Why? With its primary export crude collapsing, the rupee remained tethered to weakness despite US tariff shocks. Because we know that this currency is kind of like correlated to oil, so oil was unable to rise, and US economy, yeah, the Canadian economy and the US economy are interrelated, and due to the trade wars and all of this, we had the CAD unable to rise. The anchor oil prices, WTI crude collapsing below $60 removed CAD's primary support, neutralizing the benefit of USD weakness. Dovish sympathy, the Bank of Canada mashed Fed cuts lockstep to protect a highly leveraged housing market from mortgage renewal shocks. So, guys, they kept on cutting and matching the BOC, matching the Federal Reserve to keep their market stable. So, outlook for 2026, guys, it's going to remain neutral inside a range. Upside for CAD is capped unless oil recovers from above $75 a barrel. Unless the oil rises above $75 a barrel, guys, we expect the market to remain capped, and the target would be high would be 1.3950. We expect the market to stay inside a range. As you guys can see in the chart, oil kept on falling, and the CAD was falling with oil, but when dollar started weakening itself, CAD was unable to make a high. All it did was just make it recover itself, and hence we have that choppy market. So, guys, New Zealand dollar, what we expect for the New Zealand dollar, guys, it's the same as the Australian dollar. A rate boomer in 2025, NZD mirrored the Australian dollar's V-shaped recovery, shaking off early year weakness to finish strong on improving external demand. APEC Truce effect, like the Australian dollar, guys. Basically, the New Zealand and the New Zealand economy is correlated to the Australian economy. So when it the Australian dollar rises, NZD is to follows it, and if it falls, NZD follows it as well. APEC Truce effect, rallied in sympathy with AUD following the US-China trade pause. Risk sentiment for anti-Podian currencies improved overnight. Risk on reversal. Export resilience. Late 2025 data supplies to the upside. Dairy and agriculture export volumes held firm despite earlier global growth fears. This was a plus point for that. High correlation 2026 outlook, high correlation to global risk sentiment, which is stabilizing post APEC. So we expect the price to remain bullish as long as the sentiment remains off, risk off remains good. And guys, our target would be 0.6500. And we expect the year range to remain between 0.58 to 0.64. It's stable, and it's bullish. And guys, Ethereum. Finally, guys, we are moving on to crypto. Crypto, guys, this year, crypto made history. Especially Bitcoin made history, not Ethereum. Ethereum did to break the previous highs, but only to fall back down again. Ethereum, a year of shattered confidence. Ethereum struggled with margin call contagion from traditional markets, failing to act as a hedge during equity volatility. The October meltdown. Margin call contagion during the US government shutdown, leveraged funds sold liquid crypto assets to cover equity losses. Hence, we had the crypto crash. Capitulation low, prices collapsed to 2620, shattering investor confidence before a weak year end recovery. As you guys can see, we had a fall, rise to 4,000, even went higher than that, and we finally fell down to. In October, we started falling to 2900. We even touched 2620 after having a bit recovery in the 3000 area, guys. But still, what happened was the fall. And as you guys can see, the liquidations happened in October due to the government shutdown, and after due to that, which we had great fall. Outlook for 2026, guys, I expect this to stay inside the range with 2,500 being the bottom and 4,000 being the top of the range. Struggling for narrative dominance, needs new utility catalyst to break out. So, year to high, 2950 max drawdown, RSI neutral. It's going to remain inside the range as it has been for a long time. So Bitcoin, guys, Bitcoin was the main newsmaker. We had two high-performing assets this year, but one was Bitcoin and one was gold. But gold kept on going up till the year end. Bitcoin went up and came down again. So Bitcoin, a harsh reality check. Bitcoin proved it is not a safe haven. People started saying that this is a digital gold. This is digital gold. It's a safe haven, like gold. But no, guys, crashing during the U.S. shutdown. Gold started kept on rising during the shutdown, whereas the Bitcoin started falling. Hence, proving the point that this is not a safe haven. However, late year shadow QE has provided a critical force. The safe haven failure, October panic, behaved as a high beta risk asset, crashed simultaneously with equities during the US shutdown while gold rallied. It crashed from 126 to 85, 86 Ks. Shadow EQ savior. Fed announced 40 billion month bond buying program, liquidity injection stopped the bleeding. Price floor was established. So what we expect, guys, we are bullish on this, cautiously bullish. We expect the previous highs to be tested, and we think the 80 and 90 area will keep on acting as a floor for next year as well. And guys, here we have US oil. The poor US oil, guys, a very sad story. It in start of the year it was at $80, and it, guys, kept on crashing, and unfortunately, guys, the traders, they kept on buying and kept on buying. A structural collapse crushed by a supply tsunami from the Americas and fracturing discipline within OPEC plus. WTI surrendered the critical $60 support level despite geopolitical fears. Supply flood. US output hit a record 135 13.5 million. Combined with new barrels from Guyana and Brazil, non-APEC supply overwhelmed demand. So we did not have a fallout in demand, but instead we had an increase in supply. OPEC plus crack. Market share war reignited. Members unwound voluntary cuts to compete with US share dominance. So what OPEC was like keeping the price up, reducing their supply. So what happened? The U.S. intervened. They started supplying the market. The American countries, they started supplying the markets with oil. So what happened due to that was everyone running up to get back to sustain their market share, started increasing production, and which led to inconsistencies between the OPEC plus, and hence we had this fallout. So, guys, what we expect for the next year? I expect this for the next year, guys, it to stay in a range between $50 to $70. And that is all. Expect it to keep on ranging neutral, bearish. That is our projection for next year. And guys, the strategic key takeaways from this year were: the tale of two assets, do not basket commodities. The correlation has broken. 2026 is defined by the bifurcation of real assets based on their utility in a stagflationary trade war. So the trade war will continue, the environment will continue, the current environment. So hence we will have the gold rising and oil just ranging around. So action, buy gold over oil. The APEC pivot, that October 2031 truce is the real deal. It shields antipodean currencies for 12 months. The market is underpricing the stability that this brings to China's supply chain partners. So what our strategy is for the risk on assets. Australian NZD, keep on buying them. The Japanese U-turn, respect the unanimous BOG votes. The carry trade era is definitely over. This is the only major pair with pure policy divergence, high versus cut, high conviction, target 120.25, short this pair, a good time to sell it. Crypto's reality check, digital assets. Bitcoin is a high beta tech stock, not digital gold. It failed the safe haven test during the shutdown. Its survival depends on liquidity, not fear. Key driver, Shadow QE, Coalition Nasdaq 100. So, guys, wishing you guys the best of luck for next year. Hope you guys make money during next year. And, guys, whatever you think about our analysis, please, and our forecast, Please, re- please leave what you expect for next year and your forecast in the comments, and we will be happy to discuss it. So take care, guys. Hope you guys had a very good year, and we hope once again you will have a very nice year next year as well.